So my name is Antoine Martin. I'm not going to talk a lot during this panel. You're here for the panelists. I'll just say that whatever I say, whatever they say, does not represent my views, or represent my views perhaps, but not those of the New York Federal Reserve System. So we have very little time, and I've asked all the panelists to answer two questions. The first question is, what will be the most important development in payments, cryptocurrencies, and stablecoins over the next few years? And how will we know, say, in 6 months, that you're right, or if you're right? And so what we're going to do is each of the panelists is going to have 4 minutes to answer these questions. We're going to go from your left to your right, and Christian, who is on video, will speak last for that first question. So, Hilary?
All right, I'll be fast. So if you cut through the hype, I think it's clear that interest in stablecoins is petering out, or at the very least it's stagnating. I think this is a good thing for reasons I'll explore shortly. In my view, the only development that can halt stablecoin decline in the U.S. is legislation that creates a market and credibility for stablecoins that they couldn't sustain on their own. So the big but undesirable development that I want to focus on is the proposed stablecoin legislation. So let me start by outlining the decline of stablecoins. Although they are often referred to as payment stablecoins, their main use case in developed economies is not real-world payments, but to facilitate crypto speculation. For example, staked as collateral in DeFi protocols or as an on- and off-ramp for other more volatile crypto investments. Because their primary use case is facilitating crypto speculation, it's not surprising that stablecoin volumes have shrunk alongside the decline in interest in crypto speculation. Data from the block shows that overall stablecoin volume has pretty steadily shrunk since the crypto winter began in May of 2022, and that the individual volume for each of the major stablecoins has also shrunk over that period, with the exception of Tether, and I believe some of the others will speak about Tether. Some people might point to the recent launch of the Paxos stablecoin branded by PayPal as evidence of consumer interest. But again, there's been multiple headlines in the last few weeks about how sluggish demand for that has been. So let's not forget that the vast majority of the US population is now very skeptical of crypto, period. A Pew Research survey found that only 17% of American adults have ever used crypto, and about a third of them don't have any crypto anymore. And 75% of the Americans who have heard of crypto aren't confident in its safety and reliability. So now let me talk about why I think it's a good thing that demand for stablecoins is in decline. And the most obvious risk is run risk. In our prep call for this panel, I was very surprised to hear some of my fellow panelists describe run risk or reserve requirements as a solved problem, especially after USDC depegged from its $1 price in March. As the events of 2008 and 2020 amply demonstrated, run risk is not a solved problem for money market mutual funds, which are a very close analog to stablecoins. But no reserve requirements will ever be strong enough to ensure confidence and stability in all states of the world, even though we've tried to get them better for money market mutual funds. In some circumstances, some kind of government support or intervention will be needed to ensure stability. And I would argue that it's no longer credible to suggest that money market mutual funds would ever be allowed to fail. They're an important part of the mutual funds ecosystem. They play an important role in capital formation, and they provide funding for corporations through the commercial paper market. I think it's therefore not surprising that they ended up being bailed out in 2008 and 2020. Obviously, as we know, banks also receive explicit and implicit guarantees because of their critical payments and capital formation functions in the broader economy. So the key policy question I think we should be asking about stablecoins is, do we want to integrate them with the broader economy to keep expanding the universe of things that will be bailed out? My view is that some things should be allowed to fail, especially things like stablecoins that exist primarily for speculation rather than capital formation or payments that grow the broader economy. The good news is that I don't believe that stablecoin issuers would be explicitly bailed out at this time, although some certainly consider the Silicon Valley bailout as an indirect bailout of USDC. Enacting any of the recent legislative proposals from Congress could change this, though. Most recently, the House Financial Services Committee voted a stablecoin bill out of committee, and that bill is flawed in many ways. For example, it doesn't address the major conflicts of interest between stablecoin issuers and their related exchanges. Okay. But the fundamental problem is that it seeks to bring stablecoins into the heart of the banking system, legitimizing them and ensuring they will be bailed out without ever solving their vulnerability to runs or imposing the same strong prudential regulation we impose on banks. And I'm just going to finish up to note that this is an example of a well-honed regulatory entrepreneurship strategy that venture capital funded businesses often deploy. You may recognize this playbook from Uber. Essentially, VC funded startups strategically engage in activities that are illegal or of questionable legality until they're big enough to try and get the law changed to accommodate them. The proposed stablecoin legislation is certainly desired by institutions like Coinbase and its VC investors who are lobbying for it, but it's not in society's best interests to provide a public guarantee for crypto speculation.
Thanks. And since I'm not introducing you, you want to introduce yourself very briefly, and everybody else can introduce themselves in a sentence?
Sure, sorry. I'm Hilary Allen. I'm a professor of law at the American University Washington College of Law and study financial regulation and fintech specifically.
So I'm Stephen Deal. I'm the Chief Technology Officer of a fintech startup in London called ZeroLink. My moonlighting as a policy panel sometimes. So I'm going to echo the same kind of sentiment that Hilary has. Stablecoins are neither particularly novel, they're not particularly safe, and they're not particularly innovative. Stablecoins are, for all intents and purposes, a money market fund in which we can trade the shares on a peer-to-peer basis on a distributed network. So I'm a technologist at heart, so I'm probably the only person in the room that actually understood the last discussion. But baked into a lot of these discussions around crypto is that we have to address the presuppositions. Why do we want these things? Because not all innovation is unqualifiedly good. Some things that we can build should not be built. We can build Instagram for children. We can build Venmo for ISIS, but these are all bad ideas, okay? Crypto is basically Venmo for ISIS. If you build a payment system which basically favors a pure public ledger with censorship resistance, with no human in the loop, based on a set of networks that have completely unstoppable properties that are run on these brittle smart contracts that execute things blindly in a driverless way, you get a very brittle system. And it produces the level of scams, frauds, and consumer risk and systemic risk that we've seen happen in the crypto industry for the last couple of years. This is a bad idea. Crypto is a bad idea. And stablecoins, as Hilary said, they're not actually used for payments. They are largely used as a vehicle for on-ramps and off-ramps for crypto speculation. And crypto speculation is a completely non-economic activity that produces nothing in the economy. Okay, we can already do payments across the G20. There are very effective real-time gross settlement systems that work much more efficiently than public blockchains. So we have to fundamentally address the presupposition at the heart of stablecoins is like, why are we introducing this technology that has such negative externalities, presents with such consumer risks to do something that we can already do? And this to me makes absolutely no sense as a technologist. We should look for the simplest solution that provides the benefits in a way that minimizes the downside, maximizes the upside. And there are a lot better solutions for doing payments that have much more upsides and far fewer downsides. Stablecoins are largely a vehicle for regulatory arbitrage and regulatory entrepreneurship, as Hilary outlined. A lot of venture capital funds fund crypto companies because they want to, get in on speculation on crypto assets so they can make a return for their fund. And that's driving a lot of capital into this space and creating this sort of synthetic bubble around this tech when there is actually no use case for blockchain in practice. Blockchains have been around for 15 years. Some you could say you could go further back in computer science literature, but they are a solution in search of a problem. We can already do payments without increasing the universe of things that have run risk, as Hilary so eloquently put. So why are we building these solutions? To me, that makes absolutely no sense. And I think that the right legislative solution for stablecoins is a complete ban. There are far better solutions that achieve the same ends. And barring that, we should probably enforce the existing securities regulations so that we stymie money flowing into this space. As a technologist, I don't fundamentally see the point of stablecoins. And I think sitting here talking to a room full of banking regulators, if you're concerned about the safety and soundness of the American financial system, you should be very concerned about these stablecoins because the median value of every stablecoin right now is zero. Most of these things have collapsed. There's a few stragglers that are sort of dwindling post FTX, but these things are highly risky products that pose a lot of risk to our financial system. And for what? Why are we enabling these things? I'll turn my head.
Hello, Paul Grewal from Coinbase. It's a pleasure to be here with you all today. And I might say proudly from Coinbase. There's a lot to unpack in what we just heard. What we did promise, some spice and vigor to match the more sedate conversations that we will also hear over the course of the next 2 days. Let me start with the notion that the markets have spoken and stablecoins are in steep decline. It is true that the market caps of stablecoins as a whole have declined over the course of the most recent winter, but it is curious to me that we would focus on the decline alone without considering the overall decline of digital assets and cryptocurrencies more generally. Because if you do that, you'll actually see that the market capitalization attributable to stablecoins has declined by less than half of the overall market cap of this asset class. Now, on the notion that outside of countries that are other that are named something other than the United States, there is no real legitimate or serious interest in stablecoins. I would just encourage all of you to go to Argentina, to go to Turkey, to go to any number of countries where, forget about 9% inflation, as we were talking about earlier this morning. We're talking about inflation on the order of 40 or 50 or more % per annum. If you talk to a shopkeeper in those places, if you talk to a man or woman on the street looking to preserve the value of their labor against runaway inflation, stablecoins are a real alternative. They're not a concept. They're not a white paper. They're a way for regular people to protect their real purchasing power on a daily basis. Now, the notion somehow that, only 17% of Americans, let's talk about the United States for a moment, have engaged with stablecoins or digital assets more generally, I should say, and that somehow suggests, again, a consumer skepticism or a lack of interest. For a technology that's roughly, 14 years or less old, that lacks any regulatory framework here in the United States that would encourage participation and support adoption, that's actually a remarkable statistic, a remarkable achievement in a relatively short period of time. Now, what I think has to happen, what I think must happen, is we must, as a country, reconcile two very different worldviews that we have, and I think that are fairly represented on this stage. One is, in the face of, yes, known risks, known threats that come from any new paradigm, any new technology, what is the answer? Is the answer prohibition? I appreciate and respect at least the candor of acknowledging that the position advocated here is nothing less than a total ban. Is that the answer? Is that the way to address known risks and known threats? Or is a better alternative to adopt strict standards and real rules that deal with those risks, that acknowledge and reconcile that human beings will do things, some of which we don't like? And is the better course to simply shunt those to the side and close our eyes and close our ears and hope for the best? Or to adopt real standards through legislation for reserve requirements, real standards through legislation for transparency of those reserves, real rules through legislation that impose requirements on issuers that will mitigate, even if not eliminate, all risks in ways that are comparable to the risks that we deal with each and every day in our traditional financial system. If you can't tell, I'm more in favor of that course than a total prohibition. Thank you.
All right. Well, it's my turn. I almost feel like this is not only a confession, but perhaps a public sort of statement. So I'm Dante Disparte. I'm the Chief Strategy Officer and Head of Global Policy at Circle, and I've been uploading US dollars onto the internet since 2018. And I was a co-signer along with my dear friend Christian Catalini of the Libra project, which prior to not a single central bank anywhere in the world was thinking about anything to do with central bank digital currencies. It was buried in the annals, the technocratic annals, I would point out, of a lot of the central banks. And obviously post-Libra, virtually every central bank in the world, including the Federal Reserve System, is contemplating a version, experimental or not, a digital thrift of their national currencies, whether wholesale, retail, general purpose, or whatever the case may be, begging a very serious set of questions. If the system is so perfect, as two of my fellow panelists have described, some of whom perhaps for the postal code lottery that we have won, were born into perfect banking and born into perfect access to the financial system. If the system was so perfect, why did nothing more than a white paper rattle the nerves of everybody all over the world? And the system is not perfect. In the fires in Hawaii, The Rock and Oprah Winfrey had to use their brands and use their platforms to appeal for trusted forms of money to be sent to Hawaii quickly. And they were guaranteeing with their reputations that the money would be sent to the recipient because our systems are completely broken. The way we move money in the 21st century is flawed. And so then it begs the question from a technical audience, what is the point of a stablecoin like USDC? And I will completely concede that one half of this entire market is counterfeiting the US dollar because of US inaction on policy and regulation. But it's not my job to correct the policy environment. It's my job and Circle's job to fill the void. What is the stablecoin solving for? The stablecoin is an innovation that for the last 1,000 years in payments, the marginal improvements we've been making in payments is faster messaging instructions to the debit and credit of a balance sheet. The stablecoin transmits the bearer instrument with settlement finality the second it is sent. It also enables 75% of USDC in circulation today is held off of crypto exchanges in what are known as externally owned wallet addresses, implying a powerful global digital dollar store of value. Easy to ignore in the hallowed halls of the central bank here in Philadelphia, but hard to ignore if you're in an emerging and developing country and you're perennially locked out of the financial system. Easy to hate Facebook and WhatsApp, but hard to ignore it if you don't have access to telephony through traditional fixed line infrastructure. So I think the job we have is not to ban things. That's deeply un-American, deeply anti-democratic, and frankly, naive. The job we have is how do you catalyze responsible innovation, because you cannot put the bloody genie back in the bottle, and how do we fill a void that will otherwise be filled around us by products and services 1,000,000 times worse than the worst things that we've experienced before. Thank you.
So the hardest thing about going last is not responding to everything that was said before, but actually answering the question that everybody's probably forgotten about in the audience. I'm Aaron Klein. I'm a senior fellow at the Brookings Institution and a proud co-sponsor. And once again, I want to reiterate what President Harker said. This is Jalapa's conference, and it's just an amazing. I mean, this has become the hottest thing. I haven't had that many emails of folks trying to get into this room who are streaming online in a long time. But I'm going to actually answer the question because it's a hallowed stage and a great audience. And then hopefully I'd love to have some time to mix it up because I disagree with all four of you. What I want to say here is my vision for payments in the medium term, and I love the question over the next few years, is nothing changes. And this terrifies me. It terrifies me because Dante's right that our current infrastructure system sucks. It terrifies me because the rest of the world is moving light years ahead of us faster, as you'll hear in a later panel. There's a great presentation. It'll come from Brazil and other countries that have moved very, very quickly and rapidly. It's scary, as evidence that nothing changes. Look at the tepid sign up for FedNow that has come. Look at the volume in the RTP network. Ask yourself, if I want to move money today instantly between two digital transactions, how can I do that? At what control? I can't walk into my bank and say, use FedNow, use RTP. I have a few different apps. They often have very predatory pricing. The less money you have, the more expensive it is to access your money. And we have a problem where we've designed a system for the 50% of Americans who always have $1,000 in their account, and it doesn't matter when they are. And we are now, for the other half of the American, and by the way, the share that don't have $1,000 is growing over time, structurally, because of forces beyond all of our control. They have a very expensive and very limited set of choices. The biggest threat to that Star Wars vision, to use Brian Brooks's comments, of dystopian current reality that we have, is actually regulatory action. Whether it's a CFPB or the Federal Reserve requiring institutions to make funds available faster, which they have the legal authority to, but have sat on their hands for decades now. If you saw regulatory action that required faster funds availability, you would then see the types of changes that have occurred all around the rest of the world, where there's huge demand for instant real-time payments. What I'm afraid of is the lack of regulatory action and a passive let the market solve it approach will occur in America. And 3 years or 4 years from now, when we're at the 10th conference in the big, new, beautiful auditorium, we'll still take just as long to settle our CBDC, which we all have, commercial bank digital currency. We all use commercial bank digital currency. CBDC has been around here for a really long time. Whether we swap the first C or not, TBD. But that's my biggest fear, and hopefully the leaders in this room will prove me wrong.
Wonderful, thank you. You're not quite last, because Christian is in the last for this first question. Christian.
Yeah, sorry to disappoint you, Aaron. I also am going to disagree with some of the previous speakers. So anyone that has spent any time looking at the history of technology should be very wary of making predictions. If you read some of the statements about railways, telecommunications, you pick your technology, the steam engine. Many people said things that you heard at the beginning of this panel. This is a technology that has no value. It brings a lot of danger. But as we've often been reminded, technology has a way of solving those things and has a way to delivering value over the long term. And so looking at the beginning of a technology, yeah, there's been speculative waves in all of those historical examples, and economists that spend countless hours documenting the craziness behind the railway boom and similar ones. Not to forget, what are the basic fundamental economic forces at play here? And so I'm going to argue that to understand the role of stablecoins, but more important, to understand the role of open, permissionless networks for payments and financial services, we have to go back to basics. We have to think about basic economics. What's the basic economic theory behind all of it? I spent, now 10 years looking at this, starting at MIT, when I founded the MIT Cryptocurrencies Lab, then working on the solid and robust design of stablecoin reserves. One design that would not have the peg, it was the Libra one. So yes, I'm sorry, we could have today 3 billion people transacting freely over the internet if that project was not blocked because of the lack of regulatory clarity. So let's not forget that the application of the technology is being blocked by the status quo. But let's move past that. So what are the fundamental economics at play here? When you switch from a closed network, a closed loop system, to an open, permissionless network, like we've seen with the internet, we have immense economic value that is unleashed. We have creativity, entrepreneurship, the kind of values that have made the United States a leader in this space. It is the same logic now applied to payments and financial services. This is what's happening. A blockchain is fundamentally an open protocol that allows different counterparties to transact with each other without having a central planner, without having a central platform. These are the same platforms that we complain about all the time from a policy perspective in social media, communications, and other aspects of our life. Now we have an opportunity to use technology to open those markets back up. We've seen the playbook play before. That's what happened with the internet. Think about, your cable subscription and the options you have today. Think about how you consume the media and the many options you have today. Think about payments and financial services. Oh, wait, you have the same options you had 10, 20 years ago. They may be rebranded under a fintech app, but I think like Aaron was saying, we have not made a dent on unbanked, underbanked. We have not changed how we deliver those services. And the reason is because of lack of regulatory clarity. Now, to answer the second part of the question, the first one, again, being what is the big opportunity here? It is the use of open permissionless networks to reform, increase competition, and open up markets that have not seen competition for decades. Now, of course, the incumbents and everyone that has a stake in the current system will tell you, this is dangerous, this is speculative, this is a casino. These are poker chips. We've heard that before. Just look at the history of technology. Every time incumbents are threatened, this is exactly what they say. But to answer the second part, it is, of course, not all roses on the crypto and blockchain side either. This is a space that needs to take seriously AML, CFT concerns. How do we do KYC in a world where these networks are open and permissionless? We need better standards. We need to graduate so that we can make these open networks as safe as their close counterparts. The answer is not to leave these networks as wallet gardens in the hands of one wallet operator, one single card network or two, or one or few banks. The goal here is to use economic theory, to use these economic and technological tools to help consumers, to help businesses, and to really reform what is honestly a very outdated system. Look at PIX, look at UPI. Well, I don't think FedNow is comparable at this point to anything we've seen in many of these countries. We don't have global PIX. And honestly, we'll never have global PIX if not on truly open and permissionless networks. So sorry for being controversial, but as you can tell, the Libra journey and now going back into crypto has renewed my conviction that we do need an open protocol for money over time. These networks are here to provide it. Anyone that's standing in the progress that's being made here is essentially taking the wrong side of history. Thank you.
All right, thanks. So far, everybody's doing great on time, so thank you for that. So the second question, so the first question was, what is the biggest development in payments, crypto, stablecoin? The second question I'd like you to answer is, what is the biggest risk to your vision and why? Now, because some of you would like to contradict other panelists, you're also welcome to use your 4 minutes to do that if you think that's more effective. But again, we're short on time, so everybody has 4 minutes, and we're going to go reverse order. So we're going to start with you again, Christian, and thank you for being good on time.
Yes, I would say, the biggest risk is these networks do not incorporate some of the safety and security provisions that, decades of experience and development and institutional work, I think have solved for traditional rails. So again, I'm talking about really basic things related to AML, CFP, sanctions. Right now, it is true that some of these networks could be abused. Now, because of their small scale, I don't think we're at a range where there's a real problem. But as these ecosystems scale and graduate from early adopters that maybe are using these for investment and speculation to more mainstream use cases, I think there's real reason for concern. And so I think this is on the industry to come up with better standards and propose new technological solutions. To be honest, the technology can support all of that. You can have an identity system with better privacy provisions. You can have portable forms of KYC. Of course, regulation has to change to accommodate for all of that. But the signals and data behind these networks is often much, much better than what we have for the traditional financial system. So that would be the first thing. I think the second one, and this relates to stablecoins, again, I think there's work to be done to ensure that these assets don't depeg, that they have all the safety and security provisions that you would want. We can make them bank-like, money-like, by proposing better regulation through Congress. The Libra framework, I think, was very clear. 90 days or less U.S. Treasuries and de minimis cash and repos for liquidity. That framework would not have depegged. That reserve would have withstand stress market conditions. It would have had capital requirements similar to essentially a financial institution. And we even proposed a version of that was in collaboration with a Fed member. Again, I think we know how to solve these problems. The reason why they can't be solved today is because of the lack of regulatory clarity. And so you have a number of players in the industry, many are represented in this panel, that cannot make progress because we don't have the governance, we don't have the rules. I think they're asking to be regulated. And so I think the biggest obstacle to that vision and the United States leading in this space is proper regulatory clarity. I think we need to get them soon. Action so far has created pure chaos. Just think about everything happening around tokens and the issues with, is this a security or not? That's a debate that could have been settled, honestly, many years ago, and we decided not to give clarity to all the industry participants.
Wonderful. Thank you very much. Aaron.
Great. So since I already told you guys the biggest threat, I'm gonna engage in this conversation, and I'm gonna do something dangerous, which is continue arguing by analogy, which was brought up about Uber. And I want to start as a parent with something that I say to my kids, and I'm going to suspect you've said the same thing as a parent. And if you were a child, I'm pretty certain you heard it. Don't get in a stranger's car. This idea, don't get in a stranger's car, was contradicted by Uber. People started jumping in the backseat of strangers' cars. Was there regulatory clarity? No. Did the thing take off? Absolutely. So this idea that regulatory clarity is what's holding back innovation or usage is inherently self-contradicted by the very analogy that's being pointed to, right? On the flip side, right, was Uber a real innovation? We had taxis. We've had transportation. We've had lots of different ways to get around, right? But taxis aren't a perfect marketplace. In Montgomery County, Maryland, where I grew up and live, the taxis were run by one corrupt guy who was president of the taxi commission and a member of the local Democratic Party. And he had 95% of the taxi licenses, and it was expensive as hell to get around. And in fact, he tried to shut down Uber when it came into the county, but it had gotten too big and popular before. So you had a chartered entity that was basically living on a rent-seeking situation, and you had a group of people who were willing to violate the thing that they've been drilled into their heads since they were 4, without any government permission or regulation to the contrary. Now, let's flip. We had all these financial literacy and all these folks who were thinking about it. By the way, taxis, highest percent of people who spend the highest percent of their income on taxis are the bottom 10 and the top 10% of the income. The bottom 10%. Last mile travel. Buses don't work. You're a domestic worker. You got to go into someone's home. How you get there, right? They're time constrained. What happens to any of us if we're 10 minutes late at work? But what happens to a different group of people who are 10, 15 minutes late at work? These people are time constrained. So Uber, what happens? Gig workers. If you're low on money, you can go and drive your car. Friday was September 1st. Everybody on the panel better agree with that. If you needed to get your money in the bank because you were short on hours or short on income, right? What drives short-term dollar liquidity is not expenses. It's income. It's, go drive an Uber. Well, that's great if you were going to drive an Uber on Monday, Tuesday, Wednesday, the last week of August when you realize you're going to be short at the end of the month. It sucked when you went to Uber and said, send me the money, and they initiated the process on Thursday, August 31st, and it's going to show up on your account Tuesday, September 5th. Monday's a holiday, right? When Uber introduced same-day pay for their drivers, $5. That's a lot of money. There's a lot of data that shows Uber ain't that profitable among the driver's side. But the drivers took to it because, and that was, I believe, through Visa Direct Debit was how Uber instituted that hack on our current payment system. But the problem is we had a group of folks, and I'll close with this, who were touting this gig work situation as a way to solve the real problem for the drivers and weren't actually stopping to think through the question of how do they actually get their money. The payment bottleneck is a real problem. And the question is, how are we developing real solutions that will address these problems? And the idea that government is going to solve it, I'm dubious of, in both the regulatory and provision of the service side.
Great, thank you.
That's awesome. Reverse order is a lot of fun. The biggest risks, right? I have sat in the front row of this future of money and payments conversation for far too long, and I've sat in too many, either a Senate or a House congressional hearing as a witness or in the awkward seat behind the witness where you always have to look like you're really interested. And eventually I was just telling Senator Toomey I might have to start sizing up the seats on the other side, on the question asking side, because the United States of America is facing nothing short of a fintech constitutional crisis. And while I completely agree with Aaron Klein that if Uber had asked for permission first, they probably would have never launched their business model, a company like ours, by contrast, is regulated on exactly the same playing field as the PayPals and Apple Pays and Stripes and others. And it is a real constitutional crisis when a bank fails and introduces risk to a business model that had no fractional reserve banking in it. The technical thing is overlooked. It's very easy to everybody become an expert on stablecoin risks and the likelihood that stablecoins depeg the morning after. But here's the thing, the policy thing that sort of narrow argument ignores, which is that today, because we don't have a federal charter for non-banks in the payment system, all payments companies like Circle, PayPal, and Stripe have an exposure to commercial banks. And the commercial bank's balance sheet is designed to create credit, create lending, and no one is disputing its utility value or its societal value, which is why it has a public backstop paid for by you and me as taxpayers. But a payments company does not. And if anything, the near death extinction level event of commercial banks in the country taught us one thing, that perhaps we should also have a conversation about separating payments from banking. Because if you're a fiduciary like I am, and my obligation is to protect principal in all circumstances, including the bankruptcy of the company, then my exposure in the SVB failure and in the failure of commercial banks in America was an exposure where commercial banks imported risk to the digital economy. But I don't want to walk away from that obligation, because for all of the talk of crypto and the democratization of assets, we need banks perhaps more than banks need the technology. The challenge is the policy environment has made implied or real red lines about banking innovation and underwriting innovation in the country, and that's the problem. When we become a country that stops innovating and stops ignoring the unmet needs in the market, then I think we've lost the script. And I really do think the biggest risk we face is inaction, because in the inaction, the void is being filled by worse actors, including nation states and in Brian Brooks's, draconian version of the future, and other private sector actors that have no form or function and don't bother showing up when Congress calls.
So I think in addition to the threats that have already been articulated, I'll just call out a few others. One, I think perhaps the most important threat to a world where we see not perfection but progress in the world of payments is a fundamental misappreciation or misapprehension of what the facts are on the ground for real people in real situations. For example, Silicon Valley Bank failed for all kinds of reasons. Their exposure to USDC or their holding of USDC reserves was not one of them. I think that's painfully clear from any objective assessment of the record. I also think it's crystal clear that we have scams and frauds in this space, and that many scammers and fraudsters rely upon stable coins in order to perpetuate their criminal schemes. I think we have to acknowledge that. I think we need to deal with it. And I think that the industry as a whole has to not only accept, but embrace and call for aggressive prosecution of individuals and organizations that are responsible for undermining confidence in the system as a whole. Until we get serious about that, I don't think we're going to see progress on these other issues. The final threat I will call out is that we suffer from a failure of imagination. We heard earlier this morning, I think, from several experts on the need to appreciate and frankly display a degree of humility on any one individual, any one organization to imagine the possible and to imagine all of the possibilities that could come from any new and even disruptive technology. The fact of the matter is, it is our imagination that will allow us to solve some of these real problems. Now, we can't do so naively. We need to do so within guardrails. And it's curious to me that as an alternative to outright banning this technology, what has been proposed is to simply not legislate or regulate it at all. There is a middle ground between those two polar opposites, right? Which is to say, let's develop sensible rules that accommodate a wide range of interests, that take input and listen to voices from all corners of our society. We shouldn't just be enacting legislation that the digital asset industry itself drafts. We should be taking input from skeptics. We should be taking input from those who are deeply, deeply hostile to this technology. We should be taking input from everyone. I think if we can adopt that middle ground approach, if we can take a sensible a route towards reasonable rules, we can do this. We've done far greater things, far harder things in the history of our financial system.
Yeah, so I'll address some of the points. The biggest risk I see is legislative sclerosis, that we're not going to be able to come up with solutions as a society, because this space right now is demanding for action from Congress. And I'm afraid, there's a lot of inaction at the moment on that front. But what I want to point out, and what bothers me to no end, is I hear this phrase, regulatory clarity. And whoever came up with that phrase should win an Academy Award for acting. There's been regulatory clarity. It's called the 33 Act and the 34 Act, because all of the problems that crypto and stablecoins aim solve, they're addressing problems that we've addressed in the past. Stablecoins are effectively recreating the banknotes of the wildcat banking era. Most stablecoins, and the largest one by volume, is sitting offshore. They're not here today because they won't step foot in the United States, by the way. Printing basically counterfeit US dollars with unknown reserves that are being traded on a marketplace, which, at least in the allegations of the SEC, is operating a giant criminal conspiracy. This is the reality of crypto and stablecoins today. We can't sit here in this like platonic ideal and not look at the reality of what's actually being done. I mean, we live in a post-FTX world now. We saw what happens when these things collapse, and they can collapse rapidly. So we've not heard any single argument about why there's not a better solution to doing these things. And, I've heard the criticism that like you're just living in the first world. Well, no, I mean, there are really great real-time payment systems in other developing economies. You need only look at UPI in India or PIX in Brazil. These do not use a blockchain in any way, and they've seen massive success to do exactly the same thing that stablecoins allege to do, but without crypto, without speculation, and they're backed by the full faith and credit of a nation state. This is the kind of solution we need. It's the simplest, most rational solution without introducing sort of novel, risky, untested technologies with hugely negative externalities. So all things being equal, you should go with the simpler, best solution. And so neither me or Hilary will probably defend the current financial system. Like if I have a beer, I'll tell you like how, the current IT infrastructure is a flaming dumpster fire. And that's probably an insult to dumpster fires. There are deep systemic flaws in our society. It excludes way too many people. But the answer is not more recreating the wildcat banking era on the internet. Like we put legislation, rules, policy in place almost a century ago, and those have worked very well. Why are we trying to unwind all the safety and precautions that we put in place? For what? I mean, so stablecoins are also inseparable from crypto assets. All of the stablecoins, they run on top of networks which require the speculative assets to function. So like all of the ones that we saw today, actually, half of them are named in SEC lawsuits for being unregistered securities offerings. So if you cannot separate the stablecoins from the speculative assets, we need to have a fundamental discussion. Why are we doing stablecoins in the first place? Stablecoins do not exist in a vacuum. They are the product of crypto speculation, and that's their primary use case. So do we as a society really want more, naked speculation on, coins whose only basis is a talking dog? Do we want to create like derivatives on top of that? Do we want to create like an alternative financial system that emulates Vegas on the internet? Because that's what crypto is building. That is the reality. This Platonic ideal that we can sit around and talk about at policy conferences doesn't actually exist in practice. The reality is this sort of offshore shadow banking system that poses deep, profound policy implications for the United States, for our allies, and it undermines the safety and soundness of our financial system. It threatens everyday Americans. And I want to see that banned because I think it's risky, it's dangerous, and it's recreating the problems of the past.
Thanks. Hilary?
I get the last word. So I'm often asked, pressed, can you see any benefits in crypto? And if I'm really pressed, the answer I come up with is they're very good at diagnosing and pinpointing the real problems in our financial system. So no, I'm not an apologist for our real financial system. I never have been. I've been a staunch critic for a long time, and a staunch enough critic that I know when I see those same problems being duplicated and replicated and exacerbated in the crypto system. And so that is why I am on the team of, yes, let's ban this. Because frankly, not all innovation is good. If something is actually going to make a problem worse, why would we meet halfway on this, right? Where is the halfway point between terrible and like not so terrible? Like, why does that seem like a good policy solution for anyone? Now, I fully acknowledge that I come from a privileged background, but that doesn't mean I can't see the solutions that I think people might benefit from. And I'm a huge fan of PIX in Brazil. I'm a huge fan of some of the arguments that Aaron has made about amending the Expedited Funds Availability Act. These are things that are simple, quick, get money into people's hands without having to rely on all kinds of problematic stuff. So I talked about the fact that stablecoins are not being used and or that their use is declining. I thought it was interesting to hear that, well, they're declining less than other speculative crypto assets. Well, if they were a payments mechanism, why would they even be linked? Why would that be a defense? I don't understand. They're losing utility. They're not gaining utility as a payments mechanism. And there's a lot of reasons for that. There are a lot of fees associated with transacting in stablecoins. If we're talking about financial inclusion, which, as I said, I think is a huge problem, do you really want to expect people to pay the equivalent of foreign exchange fees every time they want to buy something in the real world? right? That doesn't seem like a great way of running things. And that's because every time you want to use a stablecoin, you have to convert it into fiat, and you go to an exchange and you pay the exchange. Then there's the gas fees that come if you're transferring the stablecoin on the blockchain. And as Stephen said, those have to be paid in the speculative underlying asset. I have to laugh every time I hear anyone talk about stablecoins and the unbanked. If you want to get a stablecoin, you need to buy it on a crypto exchange. And if you want to buy it on a crypto exchange, you need a bank account to open an account with the crypto exchange. So the unbanked aren't getting helped here. And yes, I am talking about the United States here because we're talking about policy in the United States. The discussion that I'm talking about the legislation, the policy debate, we're talking about the United States policy right here. And I am not an expert in the situation in Argentina, although I have heard a lot of those people have lost a lot of money if they've used crypto as an alternative. But our focus right now is on the debate about what works for Americans, and these are not going to improve financial inclusion for Americans. And I think there's a really underappreciated risk that we need to engage with here, and that's sort of the fragilities of the technology itself, right? We are too credulous as a society of technological solutions. They are not always the best alternative. We heard earlier about, this technology can do this technology can do that. Don't overlook the economics of this, right? A system can have lots of nodes, but if someone controls all the nodes economically, they control the system, right? So you can do everything you want with the technology. That does not guarantee a decentralized world. And in fact, we've seen far more economic centralization in the crypto space, going back to my point about exacerbating what we already have. Income inequality is worse in crypto than it is in the traditional financial system. And so I'm just going to conclude quickly by talking about these rails, these underlying rails on which all of this operates. So blockchains are software, right? They require monitoring and they require maintenance. Now, if we are talking about a tech platform or a financial institution, they employ armies of software engineers to ensure the security and integrity of their rails. Who looks after the rails in crypto? Well, if we take, for one example, the blockchain, the Bitcoin blockchain, through Wall Street Journal reporting, we know that there are 5 people who aren't technically employed. They're supported through a foundation. And I've heard that someone resigned since then. So maybe we're looking at 4 people who are in charge of making sure that this financial infrastructure is fit for purpose, is updated as necessary. That doesn't seem like a great prospect for the financial system to me. Like, we have a whole infrastructure, the principles for financial market infrastructure, designed to make sure that the pipes are well maintained. And switching to a system where the pipes are voluntarily maintained by people who potentially have conflicts of interest, we don't know who they are. What if they just give up and lose interest in maintaining the blockchain? Is everybody's assets then suddenly stranded and it all disappears? Like, these are questions we really need to be asking before we run any financial service on this kind of infrastructure. And I think if we dig into those, we'll realize that this is not a way we want to go.
Wonderful, thank you. Well, so this panel has exceeded my expectation in at least 2 ways. First, exceptional quality of very well-articulated arguments. And then as a moderator, people have been faster than I expected, which never happens on a panel. So we have actually just a few more minutes. And so I want to give each of you essentially 30 seconds to, if you have to leave the audience with one thought based on what you've said, what you've heard your fellow panelists say, what would that be? And we'll go back with the original order. So 30 seconds.
Don't fall into the techno-solutionist mindset where you think technology can solve strong, like long-standing political and economic problems.
Blockchain is a rubbish technology that is a solution in search of a problem. It is not a panacea for international development, and it undermines the interests of the United States.
If you agree with both of those perspectives, which I clearly do not, you should nevertheless agree we need legislation. We need it now.
early flight was terrifying, but to live in a world in which the FAA flies planes and builds jet engines would be a very bad outcome. And I'm afraid the monetary future that is being proposed by one half of the panel would be that one.
There's an ability to move money faster embedded in our entire existing infrastructure that is not in the economic interests of the entities that have the ability to hit that button. And without being forced to by regulators who have the existing legal authority but have not been willing to use it, the situation will not improve for the types of people who are being the worst. It drives me bonkers that people are going to be charged overdraft fees for the next 5 years to recoup the FDIC money that bailed out Silicon Valley Bank, that bailed out people who had accounts at Silicon Valley Bank. And yet we all seem to say that was okay because we had this philosophy that investors shouldn't be able to lose money. And I'm sorry, whether you have $3 billion at Silicon Valley Bank or whether you're in a money market mutual fund, it is not a failure of a money market mutual fund to break the buck. There is nothing that says that dollar is a dollar. And the government needs to be a little small c conservative and let holders of capital lose money.
Christian?
I will let history be the judge of some of the positions that are held on this panel. I would just remind us that our current financial system and a lot of our economic life, if not all of it, runs on an open permissionless network, the internet. The internet on a way to break through monopolies and reshape economic activity in those sectors. Open permissionless networks will do the same. Whether we want the US to lead on this is the question that Paul was setting. We need regulation and a framework for that. And no, we cannot go back to regulation that was written decades ago. So yeah, I'm sorry, these networks will happen whether we want them or not. The question is, do we want to lead as the United States in this space, or do we want to pass the lead to a different country?
Wonderful. Well, thank you so much to all of you. This was really great. And please join me in a round of applause.